stocks, bonds, and mutual funds are great, and people should certainly have a portfolio of that. But to really get true diversification, you've got to get involved in alternative assets like multifamily, mobile home parks, medical office. When the stock market crashes, it doesn't matter if you're large cap, mid cap, small cap, or value or growth. When there's a crash, all of those investments move with a correlation of 1, meaning they all go down together. My self-storage facility in North Carolina, it's like doesn't really impact what's going on down there. That to me is true diversification.
You also mentioned one of the happiest days of your life was when you sold your last single family home. Can you talk about how you transitioned and why that felt like one of the best days of your life when you sold that as an active investor?
Welcome back to the Peak Profits Podcast. Today's guest is Thomas Dunkel, a seasoned real estate investor with nearly 30 years of experience across real estate, finance, and investing. Tom is the driving force behind Eagle Capital Investments, where he works alongside a world-class network of professional operators to source and evaluate high-quality investment opportunities for his private investor partners. Tom is deeply hands-on, invests in every deal he presents, and is known for aligning investment strategy with personal financial goals, always with a focus of capital preservation, predictability, and long-term financial freedom. Tom, we are very excited to have you join the show.
Hey, Brian and Chris, it's great to be with you guys today. I'm looking forward to our conversation.
As are we. 30 years of experience, not only in real estate and finance and investing. I'm sure there's a ton that we can unpack here today. So excited to have you join us. So kind of going back into how you got all started within real estate and your background, can you kind of give us an overview, a little bit about Tom and kind of how you got into real estate and your background in finance?
Yeah, sure. I mean, when you say 30 years, I'm like, wow, man, where's the time gone? Feels like just yesterday I was grinding away in business school, learning and working hard. And then out of business school, I got into mergers and acquisitions in the aerospace industry, which was such a great place to start. I mean, it's just those foundational principles of, putting deals together and doing the projections and getting the capital stack together, right? So I would work with these big banks to get the debt piece done, work with private equity firms in like New York, Texas, all over, to get the equity piece. And then, they're drilling me with questions and I'm working with the C-suite people. And so it was just a great environment. And of course, those people in an aerospace company, I mean, ex-fighter pilots. My one boss was a Gold Glove boxer at the Naval Academy, went and did his tour with the Marines, and then came back and got his MBA at Wharton. And so, and not to mention the CEO, who was like a Harvard undergrad, Harvard Business School, first boss in investment banking. Anyway, it was just a great environment to really cut my teeth and learn how deals get done and how they get structured and how they get financed. So. From there, I just sort of kept building on that experience, moved around a little bit. And then in 2006, the decision was made for me to leave corporate America when I got fired for my corporate finance job. It was just, it was a third time in 4 years that I had been displaced one way or another. Like my one company decided, oh, you know what, we're going to move the headquarters from Philly to Seattle. And, why don't you come along with us? And I'm like, okay, I'm not moving all the way across the country. So anyway, so stuff like that started happening and it was out of my control. And, the definition of insanity, right? You do this same thing over and over again, expecting different results. I was like, okay, well, I don't think I'm insane. So screw corporate America. I'm going to go out on my own and see what I can make of myself as an entrepreneur. Now, this will resonate with you, Brian. I know you just had a baby. So at the time when I got fired, I had a wife and a 4-year-old and a 2-year-old at home. Wow. So I needed to make something happen quick. So of course, this was 2006. I looked around for different opportunities to get into, and I'd always had sort of an interest in real estate. Of course, 2006, probably not the best time to get into real estate in retrospect, but what the hell did I know at the time? So, jumped in, started doing wholesaling, fix and flips, picked up some rental properties. And all the while I'm trying to get my entrepreneurial legs underneath me, while the market's crashing, and it was a tough few years, but I persisted and I was determined to just kind of keep going. I was not going to go back to corporate America. And it was also around that time I just really started getting a distaste for single family rentals. Sorry to tell you guys that I think you guys are involved in that a little bit, but it's a great place to start. Don't get me wrong. But as you kind of get more into that business, and you're looking at how to scale, it gets tough to scale in that kind of world. So about that time, I discovered distressed mortgage notes. So this matched up really well with my corporate finance background and my interest in real estate. So brought those two worlds together, and I just started buying distressed mortgage notes. And fast forward to today, 15, 16 years later, my partner Joe and I have continued to build that company, and we've done about $65 million of revenue over that time period, which isn't bad for a couple of guys and a laptop and a couple admin helpers. So we've done real well with that business, and that's allowed us to do some other things. So along the way, we've been involved in a title company. We have picked up some short-term rentals, and we have a self-storage portfolio as well. So that sort of got me to today, where I'm launching my own fund, where I can bring my investors that I've worked with over the years. I've raised over $50 million of private capital, so I can marry up those investors who I've gotten to know and help over the years. Marry those guys up with these operators who I've come to know, like, and trust in different asset classes, like multifamily, mobile home park, self-storage, of course. I love private lending. A new area I'm looking at right now is medical office. I love that too. So that's kind of what I'm doing with Eagle Capital Investments. And that was a lot I just threw at you guys. So I'll take a breath and see where you want to go from here.
Yeah, that was awesome, Tom, and huge congratulations to you and your partner on the success. It must have been difficult, like you said, after those first few years where it probably felt like the sky was falling as you were really beginning your journey. So kudos to you for kind of sticking with it. I'm sure you look back at that now and go, the lessons you've learned there have probably shaped how you do things today. I do want to go back to something we spoke about very briefly before the call, but you also mentioned in your kind of story there around the single family homes. And I think, to quote you before this started, you said one of the happiest days of your life was when you sold your last single family home. Can you just explain to the listeners why? Because what a lot of people I think believe is the only way to start building wealth is to buy a single family home, and then when you either upsize, you then rent that single family home, and that then becomes your first rental property, and people continue to do that. Or you buy a single family home and that becomes your first rental. Can you talk about how you transitioned and why that felt like one of the best days of your life when you sold that as an active investor versus what you're doing today?
Yeah, sure. I mean, look, everybody has to start somewhere. And I think, buying a single family rental is sort of a first, dipping your toe into the world of real estate investing. Because, up until I bought my first investment property, the only house I had bought was the one I lived in. So, I kind of jumped in, and there's tons of information out there about, how different ways to acquire these properties, and you can, do subject tos and all this cool stuff. And so for someone who's, newer to that type of world, that type of thinking, that type of strategy, because up till then, a lot of people, they've only ever invested maybe in their company 401k or stocks, bonds, and mutual funds, or their brother-in-law's a financial advisor. So it's a great place to learn. And it's because it's really a microcosm of any other, bigger asset class out there. Because, you've got repairs you got to deal with, you have tenants you got to deal with, and so you learn about that. And then of course, there's municipalities. One of the things that's happening right now is a lot of property taxes are going crazy, and insurance is challenging in different places. So to learn those kinds of things, and frankly make those mistakes at a smaller scale, will help because you don't want to make those mistakes when you get up to a bigger scale. But I guess kind of the thought process that I went through with my experience was, it took some time and it took some experience, and frankly it took some wealth building before I had the capability to then say, hey, you know what, I don't want to deal with the water heater that broke. I don't want to field the calls from the property manager telling me about the roof leak. So I was able to get to a point where I could take money and invest with other people, which really unlocked a lot more lifestyle for me, which is very important. I was very involved with my kids as I was growing up, as they were growing up. Scouting and sports and school and music and all that cool stuff. And so that was very rewarding and very important to me. There's a mentor of mine, Darren Hardy. He explains how you want to build your life plan, and then you build your business plan to fit within your life plan. So what do you want your life to look like? Do you want to be able to go to a 2:00 talent show at your kids' school? Do you want to be at 3:30 basketball practice? Do you want to go on a 2-week backpacking trip with your Boy Scout? Those kinds of things. So, I think it's important to be able to fit all those things in, and then you build your business. So when I was running around trying to manage these single family rentals, even though I did have a property manager, it was still very hands-on, and it really kind of bogged me down. So, like I said, I was learning a lot, but I knew in the long run, it wasn't going to get me where I wanted to be as far as, lifestyle and scale and wealth and those kinds.
Yeah, I love that. There was a ton that you just said there that I think deeply resonates with what I'm going through with just having a baby and wanting to be present, but also the avatar of investors that we typically work with in technology sales, software sales, high earning W-2 professionals that frankly are very good at their jobs. They're making high earnings, few hundreds of thousands a year and more. And do they want to trade their excess time or extra time that they have outside of that job to try to find, manage, and build their own real estate portfolio? Yep. Or do they want to partner with operators that have done it and built really a foundation and place their capital with them to earn sometimes better returns than what they would get typically in their own ventures, while also saving their lifestyle of what they're looking to build and grow into? So that's a lot of what we talk about on the show. I think it's a lot of what our listeners are going through right now. They might have a single family or two, right? Maybe a duplex or a triplex, and they're trying to figure out what that next move is. Do I continue to try to scale, or is this headache that I bought 3 years ago, right, that maybe isn't going exactly as I thought it would go, where it's just I collect rent checks? Do I want to stay that route or go kind of the passive route? And so that was well explained in your talk track there on kind of the difference between what we're doing and what we talk a lot about on the show. And so a lot of things you talk about is, the 4 steps of a predictable portfolio. So I think when you're thinking about your capital allocation, specifically real estate, you talk about these 4 steps of building, a predictable portfolio. So can you kind of walk us through that framework at a high level of what that means to you?
Yeah, I'd love to. You're spot on. The high achievers who are, picking up these properties, they have decisions to make. And so the 4-step process that I've developed, it helps that type of person, develop the multiple streams of income that they need, so that when there's a disruption, not if there's a disruption, but when there's a disruption in their career, like, I don't know, maybe artificial intelligence comes along and like wipes out a ton of jobs, right? Or, way back when, I was in investment banking when the internet bubble burst. Is like, okay, that's pretty big disruption. So, there's always going to be some kind of disruption in your career. So you need to have multiple streams of income, multiple stores of wealth, so that you can weather those storms in style, right? So the 4 steps are pretty easy, right? So step number 1 is very simple, but people seem to gloss over this one, which is you need to have some goals. Like, what are your goals for your investing? Are you saving for retirement? Are you saving for a kid to go to college? Are you saving for a second home? Or, are you saving to help, take care of an older family member or something like that? So what you don't want to do is mismatch your goals with the types of investments that you're in, right? So like for me, for example, at this stage of my career, I'm very interested in capital preservation and cash flow, right? I'm a little less interested. I mean, growth is great, don't get me wrong, but it's not like number one. So I'm not going to look at a real estate development deal, right? Because they're very risky. So my capital preservation is in question there, and there's no cash flow. So why would I look at that deal? So it's easy to say no, which helps to filter through all of the gazillions of deals out there, right? When you have those goals, and then you get your goals, then you go out and you find deals that line up better with your goals. So like right now, I love private lending because we're in this kind of uncertain environment. Where are interest rates going? Are we going into a recession? Is there going to be a war? Like, what's going on with these tariffs? So for me, just getting that monthly payment from my borrower that I lend to, it's a high yielding payment. I'm secured by property, so that capital preservation is pretty solid, and the cash flow that I get is very high yielding, and it's consistent. So I like that. So then number 3 is you have to have a diligent process for analyzing deals. And so over the years, I've developed what we call the SAFE investing method. So investing isn't safe. Don't come to me later and say, oh, Dunkel said investing was safe. No, SAFE is an acronym that hopefully will de-risk your investments so they're safer. But SAFE is an acronym. S is for sponsor. Who are you doing business with? Who is this person you're handing over your hard-earned money to? You need to spend a lot of time understanding that person, their background. And the way I look at it is, if I'm sending somebody, $100,000 or whatever, that gives me the permission to ask like personal questions, like, have you had a bankruptcy? Have you had a foreclosure? I want to do a background check, so you got to go through those things. A is for asset. What is it that you're investing in? And can you explain it to your young kid or your parents or something, right? Somebody that's not super sophisticated, because if you don't understand it, you shouldn't be investing in it, right? So, multifamily, that's something I can get my head around. It's a big apartment, people live there, it's not super complicated. I mean, there's certainly a lot of complexities and nuances and whatnot that you need to understand, but at a high level, it's pretty straightforward. And as far as the asset goes too, you want to look really closely at the market where that asset sits, right? So like I like investing out in Phoenix for multifamily in particular, because we touched earlier on property taxes and insurance, right? As those can be big swings on a deal. Well, in Arizona, there's a 5% cap on property tax increases each year, which is awesome, because in a lot of places, like in New York State, we got hit with an enormous property tax hit, which was ridiculous. So we had to go and fight with them and all this stuff. Anyway, 5% cap on property tax increases. And in the Phoenix area, there's no earthquakes, there's no wildfires, there's no floods, right? So as far as an insurance aspect, it's not like in a hurricane area like Florida, where it's really hard to get insurance these days. So anyway, so you want to look at those kinds of things that impact the asset as well. F is for financials. What are the financial projections? Are they realistic? Has the sponsor delivered on these kinds of projections in the past? What are the tax implications? Those kinds of things. And then lastly, E is for exit. How do you get out of this thing, right? It's not like you can go to schwab.com and click and sell your position in like a multifamily syndication, because it just doesn't work that way. So you need to know, eyes wide open, going in, your capital is going to be tied up for X period of time. Could for private lending, those are 1-year notes. So I can get my head around that. That's pretty good. I can ladder those and have, payoffs, trickling in, and then I can redeploy. Something like a multifamily property that might be a value add deal. That's going to be more like a, 3 to 5 year type thing. Whereas a development could be, 7, 8, 9, 10 years. So again, that has to match up with your the goals that we talked about in the first step. So that's step number 3. And then number 4 is easy. Just friggin' do it, Get yourself, a good guide, a good advisor, someone who's been there, done that, and just, follow their advice. They'll lead you through the process, and just go do it, and then rinse and repeat and go do it again.
I love that. We are going to hold you to the whole everything is safe piece. We'll have to hold you to that one. I think you've mentioned some really, really important pieces there. But one of your key things is around capital preservation comes first. And that's what you mentioned is one of your priorities alongside cash flow. I don't think anybody invests to lose their capital necessarily, right? So capital preservation should be at the forefront of operators' minds, those sponsors' minds, right? Like investing, protecting investors' capital should be part and parcel of everything that they do. Yep. So how do you balance some of the growth that you've had within your career? And you mentioned now you look at this slightly differently, like growth is great, but that's not the number one priority for you. Cash flow is, right? And that's based on your specific goals. But there are going to be people out there that are investing where growth is part of what their goals are. So myself personally, growth is one of my goals. Cash flow is also one of my goals. So I'm balancing the two, and I invest in multifamily properties and also private lending as well. So how do you kind of speak to your investors that are more interested in some of the growth, and how do they protect almost the downside potentially? And what are those like non-negotiables that you would look for as an investor, but also that you would share with your investors around?
Sure. Well, in my mind, Chris, that's a great question. Growth is necessarily more risky as compared to like capital preservation or cash flow. So again, you need to go into that eyes wide open, and typically a growth scenario too in real estate and probably other asset classes as well is a longer time horizon kind of proposition, right? So if you're cool with that, great. But again, I'd go back to the SAFE method, and for the higher growth, the higher risk that you're contemplating, the more I'm going to really hammer on the S, on the sponsor. Have they done this kind of deal before? If we're talking about like ground up development, for example, if it's their first go around, probably not going to, be too excited about jumping in that one. But if they've done it 50 times and they lost on these 3, 4, or 5, or they had some that, but they, what did they learn from those experiences? And by the way, if you come across a sponsor and they're like, oh, we've never lost investor capital, or we've never had a bad deal. I mean, to me, that's kind of a red flag, because if you've been around long enough, you're going to have something that goes sideways somehow. And it's just a matter of how do you move forward from there, and how do you communicate with your investors about what's happening, because we've had deals go well. This is something we learned a long time ago. I'm getting a little off track, but stick with me. Even when a deal is going well, if you're not clearly communicating with your investors, like they get very suspicious very quickly. So that's why we regularly are communicating with investors, even if there's not much to tell. we just want to, just stay out in front of them, let them know the lines of communication are wide open. So back to the whole growth thing. Yeah, I would hammer on the sponsor, make sure their track record is solid there, and that interests are aligned, right? A lot of deals, if you look into them a little bit, it's like there's the acquisition fee, and there's a development fee, and there's this fee, and there's that fee. And now look, your sponsor needs to have sources of revenue to keep the lights on and keep the team working on your deal. So you don't want the fees to be zero, right? But you just want them to be customary and reasonable. And then to the extent there are fees, and maybe if they are a little higher than you'd like to see, then you better see that maybe the split on the back end is more favorable to the investor, or there's some balancing there that's going to keep the interests really well aligned. And that's one of the things I do at Eagle Capital Investments. Like my people, my investors, they don't even see a deal unless I'm ready to write a check for it myself. And so that aligns our interests really, really well. Now I do make, fees here and there, again, just to keep the lights on, cover legal fees, accounting, stuff like that. But our interests are aligned in terms of, if the deal goes well, we're all going to do well. If it doesn't go well, my legal fees are paid for, but other than that, I don't make any money, so stuff like that. But I think those are the, couple of key things to look at in terms of, growth versus other things.
Yeah, I think that's super important. And I think what you're explaining and how you're running your business is very similar to how we think about our business at 7P Capital, right? And just being just as transparent as possible to your investors and open communications. Like there could be a monthly update where, you might provide some financial metrics, but they're outside of that, right? It might be quarterly distributions, but you still provided a monthly update. And there might not be that many substantial updates on the property or the deal, but you still want to have that level of communication. So they're still aligned with what's going on, right? And I think regardless, good, bad, or indifferent, you want to make sure that you're doing that to your investors. And they place a lot of trust in you. And I think that comes across, very well received from all investors. So you mentioned you guys work with world-class operators. As you're building your business, what does it look like to really vet out those operators? What are you looking for in world-class operators across different asset classes and what they've done before? Track record, I'm sure, maybe past performance, but can you elaborate a little bit on how Tom would meet a new operator and decide, this is one that we like?
Yeah, for sure. So typically the way that works with me is just having been out in the world for, 30 years altogether, but 20 years as an entrepreneur doing things in real estate. I go to the conferences, I meet the people, I talk with them. I'll be in the audience. I'll see a panel of sponsors who are doing cool stuff. And if one of them seems like they're working on something that lines up with my goals, I'll go chat with them afterwards. But, it's a long-term process. And like when I go to a conference or I'm in an investor, if I'm in a networking event or whatever, and I introduce myself as a fund manager, I raise capital for private deals, I become very popular very, very quickly. So I have a lot of people come to me like, hey, I got this deal, blah, blah, blah. And the first thing I tell them is I say, hey, look, I say no, like all the time. I say no a lot. And the reason is because since I have been around a lot and I do have now, operators who I've come to know, like, and trust, like personally, like I can pick up my phone and text them or call them or whatever. Those relationships and that trust, takes a while to build up. So I'm never gonna, get an email from, somebody looking to do an apartment deal and they're looking for investors and, sign up here. I mean, that's just not how I work. I mean, ideally I want to meet the person in person. Want to meet them in person, break bread. Because, it's one thing to meet somebody when they're pitching you, right? And, they've got their, their best suit on or whatever, and, they're on their best behavior. But, when you go out to dinner with them or whatever, if they treat the wait staff like garbage or they're, obnoxious or, off color or whatever, it's like, okay, I want to maybe think again about how to, if I want to do business with this group. And that's the other thing too, is you want it to be a business, right? You don't want it to be like, Joe, apartment guy at gmail.com, right? You want them to have, a good website with shows, some of their deals and their portfolio and their background, and testimonials from investors would be ideal, right? And then, like I was saying earlier, if you do get down the line with them and it does look like someone you want to do business with, even if you like them, even if you trust them, just, from your interactions with them, do the background check, right? Ask around the community about, has anyone worked with this group in the past? And, what was your experience, kind of thing. So those are, it's like dating and then, and then getting married, right? It's like, it takes a while, for you to really get comfortable to the point to make a big commitment to that.
Yeah, it's interesting you say that, Tom. Brian and I have essentially gone through this journey. This week decided that we would partner with an operator, but we've been working with them for over 2 years already to this point. We've met them numerous times, right? To really understand and break bread and recognize who they are as people, as a business. And I think it does go an awful long way when you have those connections, those relationships. You see the good, the bad, the indifferent, because like you said, if everything is always going swimmingly, that is a red flag, because things in this world happen. And it's like you said, it's how do they learn from that? How do they adjust their business plan? How do they preserve investor capital, right? Like all of those things that we've spoken about become extremely important. I do want to just switch gears slightly here, Tom, because you've mentioned you had a significant mentor very early on. You mentioned you go to a lot of networking groups. I'm going to throw an assumption out there, but I'm sure you're probably part of some form of masterminds or continuous learning processes. Like, how has that helped you personally, but also helped you within your business? And what advice would you give to people that are either slightly against joining a mastermind or finding mentors? Because again, I can speak for Brian and myself. We've both have mentors. We've both been part of masterminds and are part of masterminds. And for us, they've personally been a huge help in really learning from other people's mistakes and trying not to follow the mistakes that they've ultimately made. Now, of course, you're always at some point going to run into your own mistakes, and doesn't matter how many times people tell you you probably shouldn't do this or you should do that. You will still learn to find your own way in some capacity. But how has that helped you in your personal and professional?
Yeah, that's such a good question. I have to say, geez, at this point, oh man, if I had to guess, I think I've spent probably $350,000, give or take, on different types of, conferences, mentoring, masterminds, small group, types of things too. Like, and why did I do that? Because, you don't know everything, and that was something that I learned early on when, so here I am, right? Going back to 2006, right? I had an MBA from a great school. I had this great career. I learned a lot, worked with some amazing people. And so when I got fired and I was going to do my entrepreneurial thing, I was like, this is going to be a piece of cake. I've got this great background, blah, blah, blah. I've got a pile of money. I'm ready to go. And man, I was wrong. I thought I could do it all myself. I figured out, well, if I just follow this system that I bought into, then that would work. And anyway, it was a disaster. But definitely what I learned from that is to learn from people who have been there, done that, made the mistakes, like you touched on. I mean, it's I think you learn more from people who have made mistakes than people who have just kind of had smooth sailing. Like in a mastermind I'm in, there's a guy there, he like lost $35 million or something. Like, and now he's building it back up. And so, you just meet these people and learn from their stories. And the other thing too is just is the energy, like, and just the ability to like be able to pick up the phone and just call this guy, who lost all his money, and be like, learn more from his experience, and get one-on-one and that sort of thing. So I think that investment, it's an investment. It's not an expense. It's an investment in your future, and it pays, big dividends if you put in the work, if you make it a priority. Because if, a lot of people, right, they buy a book, it sits on the shelf, or they go to a seminar and they buy a course and it sits on the shelf. You have to do the work. The resources are out there, the people are out there. Even like me, like, if you want to call me up and talk about whatever except Eagles football, no Eagles. I'm very disappointed in the Eagles right now. But if you want to talk about, whatever, I'm happy to get on the phone, especially at this point in my career. I look at myself as, much more of a, kind of a mentoring kind of role, because I have been fortunate to, be around great people and learn cool stuff and implement it too. So, yeah, the masterminds are very important. And, they're not every mastermind or group is for everybody. So, go check it out. If it resonates with you, great, move forward. If it doesn't resonate with you, don't move forward. But find another one that maybe, clicks with you. So, and especially these days, there's through, Zoom and whatnot. It's like you can, I'm part of a mastermind now. It's based out of the West Coast, but it doesn't matter. And I'm part of a mastermind that's out of the UK. So it's like, it doesn't matter because of technology these days. Now it's great to get together with those people, and they do have in-person events, and those are important to me. But some people are cool just living in the in the Zoom virtual world, and that's cool too. But just make the investment of time and money and effort, and you'll get a ton out of it.
Yeah, I completely agree. And like Chris mentioned, we've been and are part of several mastermind groups, and I think there's a ton of benefit to that. And a lot of people might see sticker prices on some of these things of $25,000 or more and say, damn, like, why am I paying that much money to be part of a group? But if you really break it down, like, that is minuscule to you wiring $50,000, $100,000 on multiple deals over the next couple of years. And if you're still what most would consider like an amateur kind of private investor, you want to make sure you're doing your level of education, and that for that cost, you're surrounding yourself with people, again, that have been there, that have made mistakes, and you are potentially buying back years of mistakes or building success now that you might have taken 5 to 7 more years to try to learn on your own. Even though we have the AIs of the world, right? There's information overload everywhere, and it can get overwhelming. But in a group like that, right, you have not only the content or the resources or the people, but really that group environment that people push each other and want success. And I don't think your success takes away from our success. And I think they go a very long way. And so, yeah, I was thinking about all that when you're explaining it, and I think it's definitely important. So super exciting. I would love to know kind of what, have you done any deals in the last like 12 months in 2025? We're coming out of, what was the peak, right? Several years ago. It's been a tough environment. And what does 2026 look like for you?
Sure. Yeah. So 2024, I transitioned out of my role as chief investment officer at Belrose Storage Group. And, that was planned, years ahead of time, but I told my partners like, hey, I'm going to want to, kind of take a step back. And then 2025, frankly, I took huge chunks of time off. Just, did some traveling, visited some family, got married, and super 2025 was awesome.
Congratulations.
Yeah,
hell of
thank
a
you very
year.
much.
It doesn't always need to be professional at all times. Take some time
that's
for
right.
yourself.
That's right. Yeah. So so that was a ton of fun. Went to Italy. We have a daughter who was studying abroad in Italy. So I was like, wow, she's going to Italy. We're going to go to Italy. So we were over there for a while and came back. We were in Bahamas. We were in Scottsdale. We were up and down the East Coast. Anyway, we had a great 2025. I was doing things here and there to kind of get Eagle Capital Investments ready to launch. I've been working a lot on our back end, like our our CRM, and just kind of getting some marketing strategies in place. I did do one small deal last year. I mentioned Phoenix Multifamily. So I've got a great operator out there who come to know, like, and trust over the last 4 or 5 years, and so was able to raise some capital for myself and some of my partners to invest in that deal, which is going very well. So we're excited about that. But yeah, then here we are, early 2026. I'm looking to really ramp things up this year. I gotta get back to work a little bit. But kind of like we touched on earlier, I'm looking for deals for myself. So so to the extent I'm cultivating those relationships and the mobile home parks or the medical office spaces, and that sort of thing, I'm going to start having those deals, vetting them through my safe investing method that I use for myself as well. And when I find something that looks cool that I'm really willing to put up my own hard-earned money for, I'm gonna let my partners out there in my database know. So it should be a good year. Probably looking to do maybe 4, 5, 6 deals this year. Not a ton, but when I find them, I think they're going to be good ones. And so like I said, I say no a lot to operators. I say no a lot to deals. So I feel like when I do present something to my network of investors, like, it's pretty darn solid.
Quality over quantity for sure.
Hell yeah.
In this space.
Yeah. Mm-hmm.
Tom, you've deployed over $50 million worth of investor capital. First of all, huge congratulations, because that is by no means any small feat.
Thank you.
What advice would you give to other fund managers to get to that? You just sat and mentioned that you were traveling around half of the world. It seems like great places as well. Absolutely love Italy. While you're working on things like your marketing strategies and stuff like that, like, what advice would you give for fund managers as well?
Yeah, I mean, being a fund manager is a huge responsibility, right? I mean, you're taking investor capital that that they've been working hard for, and so sadly, there are people out there take advantage of that, or they don't really do their due diligence, or they invest with operators. They get so excited that there's a deal, they kind of race through their due diligence process, if they even have one, just to get something done. So I just would really encourage people and just emphasize that you're working with people who are relying on you to be a good steward of their capital, and if things go wrong or something, could have a significant impact on them. And so you need to take it super duper serious. And aside from that, I think that's sort of the overarching kind of principle and responsibility. And then from there, that's why you need to have a due diligence method, have the safe method, so that you can really vet deals. Because I've met plenty of operators who I thought were cool, or we hit it off, or we played golf together and we had a good time or whatever, but there was something along the line that just didn't resonate right with me, and so I haven't done business with them. And that's just that's just the way the world works, right? I mean, you got to make those hard decisions sometimes to say no to somebody that you like. And so sadly, there are people out there who cut corners and this and that, and I think that's those situations pop up when your incentives are not aligned well. So again, just sort of back to the sponsor and the deal structure and stuff, just make sure that all of that is in proper alignment. But aside from that, I think we're as capital raisers and fund managers, I think we're providing an incredibly valuable service. Stocks, bonds, and mutual funds are great, and people should certainly have a portfolio of that. But to really get true diversification, you've got to get involved in alternative assets like multifamily, mobile home parks, medical office, these things we've been talking about. Because when when the stock market crashes, and I've lived through many of them, it doesn't matter if you're, large cap, mid cap, small cap, or value or growth. When there's a crash, all of those investments move with a correlation of one, meaning they all go they all go down together. But you know what? When the stock market crashes, my self-storage facility in North Carolina, it's like, doesn't really impact what's going on down there. And the multifamily property out in Phoenix, they're not really going to impact that either. So, that to me is true diversification. So when you start looking at diversification really as a multi-dimensional kind of thing, right? It's geography, it's operator, it's asset class. And you can have a diversification of strategy too, right? So even though I'm primarily capital preservation and cash flow, I did make an investment last year in a total long shot, a startup technology company in the real estate space that a good friend of mine got involved with. I trust him a lot. He has an amazing background. He shared with me about the backgrounds of the principals who have all had these, huge exits on technology companies in the past. I was like, all right, I've got some risk capital here. If I lose it, it's not going to be the end of the world for me. So I threw a few bucks at it, and so far so good. It's a growth investment, so I'm not going to see anything for a while. No cash flow, no nothing like that. But that's something that it could be a 0 or it could be 100, right? It's it's asymmetric, right? So that's my favorite word of the day, right? Asymmetric, meaning it has limited downside but huge potential upside. So sprinkle a couple of those in your portfolio, but stick to your main strategy. And and you should be good.
Tom found the next Facebook. Let's hope. No, that is awesome, and I completely agree. I think to some capacity, I still have public market exposure. I still have mutual funds and some things like within my portfolio, and I think it's so important. But when you start to look at your whole portfolio as a whole, it's like a pizza. It's like how much of that do you want to diversify into public markets and or then real estate? And primarily, a lot of my net worth is in real estate in itself. And I think diversification is super important. And again, it's something we talk about, and I'm sure your investors that invest with you have a ton of confidence in coming to you and asking for that advice. And is a reason why they invest through you and through the relationships you built with these operators, because that's essentially how we're building our business as well. Is you are connecting top tier operators with your investor base and your network, and they appreciate your input, and they know, trust, and like and trust you, and they have confidence that you're going to, if you're putting your own capital in, obviously, then you feel strongly about these investments also. And then not only do you bring them one operator in one type of asset class, you can give them a diversified option, right? And they don't have to invest in every deal, right? They might look at all of the deals you present this year, be it 4 or 5, and say, hey, I don't love this one for X reason, but I love this one because of the asset class or the geography or the operator's track record. And I think that's where fund managers really come into play and have a strong impact on, these investors that we're helping out with, so they can focus on their W-2 and their family and things they want to focus on. And we can help, be a steward to bring them opportunities that come up within our network as well. So,
yep.
Tom, this episode has been amazing. You've shared a ton of exciting stuff, and I am super excited to see kind of how you grow Eagle Capital Investments in 2026, and would love to closely stay in touch on what you guys are up to. So where can people find you? Where can people get in touch with you if they want to reach out and get on your list?
Yeah, awesome. Brian and Chris, has been a blast. You guys are great questions, great conversation. Yeah, so investwitheagle.com is the best way to reach me. Tom Dunkel, managing principal at Eagle Capital Investments. If you go to investwitheagle.com, you can get a free copy of my book, the Wealth Builders Playbook, where it goes in depth on the SAFE method and the 4 steps of building a predictable portfolio, and lots of stories and corny stuff in there that I came up with. I had some fun writing it. I'm a golfer and a bourbon guy, so there's a lot of talk of golf, bourbon, and investing in there. So
hell yeah, hell yeah, hell yeah. I like all three of those.
We'll have to get on a course, Tom.
Yeah, for sure.
We're Giants fans over here, though, so there'll have to be some friendly rivalry there.
Yeah, well, that's fine. That's fine.
Yeah, I don't
know. How many Super Bowls you guys got recently? I don't know.
Sorry, the Giants dynasty has begun.
Yes,
with Harbaugh.
Harbaugh, yes.
I know.
Awesome. But yeah, investwitheagle.com. Head there, and then I would love to catch up with any investors that just want to talk some more, learn a little bit. Talk about golf, bourbon. I'll talk about the Eagles if you really want to. But yeah. Tough, frustrating end to a frustrating season. Last weekend.
Yeah. They got to get rid of that OC.
They did.
Well,
I don't know why they didn't get rid of him earlier in the season. The day after they got rid of him. It's like, that's too late.
Yeah. Yeah, it sounds like we need to get on a course. On that topic, do you have any conferences or meetups or anything travel that you have planned or are thinking to get to this year? We always love getting to events. So just curious if you have any plans.
Yeah, definitely. So far this year, I've actually connected with an infinite banking guy who's out of Newtown, Pennsylvania. It's kind of between where I am and where you guys are.
I'm from Lehigh Valley, actually.
Oh, are you? Okay, cool. So he and I, he used to have a meetup group and he's restarting it. I used to have a meetup group. And so we got to know each other, like each other, we saw some synergies and, wanted to work together. So we've restarted what's called the Builders Circle. And I can get you more info on that, but basically we're meeting once a month, starting out in Newtown. Nice. And then, in the spring, next year, we're going to start alternating between Newtown, Pennsylvania, and the main line where I live.
Yep. Nice.
But that's, awesome. It's a small curated group. We're not looking for tons of people. We're just looking for good people. And everyone's sort of in the, in and around the real estate business. So be a good group for you guys.
We'd love to get some more information on that, Tom.
But yeah, aside from that, I don't have any plans yet. But as you've probably picked up from me, Eagle Investments is definitely kind of a lifestyle company. So if there is a conference out in Scottsdale or something, or Miami, I don't know, somewhere nice where there's some good golf courses, I'll probably make an excuse to go to it.
There we go. Well, Tom, this has been awesome. Thank you so much for sharing your story. There's a lot that people can learn from this. Invest with Eagle. Everybody go and check it out. Get Tom's book and schedule a call with Tom. But Tom, thank you so much. This has been great, and we look forward to staying connected.
Awesome, guys.